Welcome, everybody, to another episode of Smart Money Circle. I'm your host, Adam Sarhan. Today's guest is Dan Moskowitz. He's president of Chatham Wealth Management with $350 million in assets under management. Dan, thank you very much for being here.
You're welcome, Adam. Thank you for having me.
Dan, can you start by giving us your story, how you got involved in this business?
Absolutely. So my stepfather had a business in New Jersey. He was one of the first fee-only financial advisors in 1978 when he hung his shingle for the first time. And he had been at U.S. Trust for 17, 18 years, 60s and 70s. And he started a business, as I said, in 1978. In 1998, he approached me as an exit strategy, and we formed a partnership a year later. And by 2004, he was retired, so I've been running the business since 2004, and I've built a very good team here since then, and things are going well.
Oh, congratulations. I love those kind of stories. Tell me a little, if you can, about your investment strategy.
Sure. I'd say we're different than 80% of investment advisors out there today. You know, we are the old trust bank model where we're buying individual stocks, individual bonds, managing risk, managing the money in a tax-efficient manner. No models, no ETFs, building truly customized portfolios and customized financial plans for our clients.
And are you more fundamental or technical in nature? Combination of both?
Definitely more fundamental. We pay attention to the technicals, but I wouldn't say it's top of the list in terms of how we're making our investments.
So you spoke about tax briefly. I know you have more of a holistic approach. Can you explain or walk us through the customer journey when they come to you, what the client should expect and what they get and how you differentiate yourself from the pack?
Right, absolutely. So we have a three-person team that has direct contact with the client. We have a relationship manager, we have the bond manager, myself, and then we have an equity manager in John Louis. And it's a three-person team that is always available for the client, and we're managing every aspect of the investment process, including the planning.
Okay, fantastic. So not just, hey, pick these stocks. It's also more of a comprehensive approach of, hey, there's a plan. We want to make sure everything's tax efficient, et cetera, et cetera. Is that correct?
Yeah, and even the relationship manager has 30 plus years of Wall Street institutional investment experience. So we're used to making decisions based on the fundamentals, and we have access to all of the institutional research. The three of us have 30 plus years of experience. We each have a vast book of contacts that we rely on to get the information that we deem is needed in order to make the experience for our clients a successful one.
Understood. And you do bonds and stocks you mentioned. How do you divvy that up as far as allocation? Are you more of a fixed income kind of guy or more equity guy, or is it a blend of both?
So I'm clearly more of a fixed income guy, although I've been managing equities for 20 plus years as well. But I got my start on Wall Street selling and trading institutional bonds, basically mortgages, governments, and corporates. And so that is what I do here first and foremost. But we are not, just because I'm a fixed income guy doesn't mean we have a lot of fixed income. Going into 2008, we had 45-50% of the assets in fixed income. Today, we have closer to 20%. I've been in the bond market for 30 plus years. I've never seen what I deem as the worst risk-reward scenario since I've been in the business.
Then right now?
For fixed income.
And why is it?
A 10-year note yields 1.7%.
Right.
And the last thing I want to do is lock my money up for 10 years at a rate where I know I can't even beat inflation.
Oh, there you go. That's just like to clarify for the audience. That's all.
Right, and that doesn't even get into the credit aspects. I mean, those are government bonds, and then you talk about where single A and triple B credits are trading, and certainly the risk reward there is probably even worse because you're not being compensated for the risk that you're taking.
So, I mean, let me pick your brain a little bit about that and help educate the audience as well. With 16 trillion, I believe it is, or 14 trillion, some whopping number of negative yielding debt around the world, what is your thoughts on how this impacts, risk and assets and just where money is being allocated? Is it an artificial bubble that'll burst one day and it'll be worse than '08? Is it one of those situations where, hey, this is just, it is what it is, deal with it? Or, just curious as how you allocate in this kind of a environment, and without giving
No,
specifics.
I would say allocating today is more difficult than it's ever been, both on the stock and the bond side, but especially on the bond side. When you mention negative yields, I don't think we're going to see negative yields here in the United States, but it is a possibility.
Got it.
But I would rather have my money in some more liquid, safer assets, things that I can get my hands on, rather than lock it up for an extended period of time.
Understood.
In their current environment.
Got it. So from a stock side, as from a valuation standpoint, since you're more fundamental, do you look for stocks that are undervalued? Do you look for distressed assets, or you look for GARP with growth at a reasonable pace, or how do you?
Yeah, we're looking to build a diversified portfolio of high quality stocks at reasonable valuations. And I was talking to the team this morning, and I'm starting to look at utilities, right? Good old boring utilities that have done great. Nextera, PG&E, right. Those sorts of stocks that have really done well, trading at 24 and 25 times earnings, yes, with half of the yield that they had 2 years ago. Historic growth rates or for those sort of stocks is around 4 or 5%. That seems like a recipe for disaster.
Right.
When on the flip side of that is there are some opportunities out there. Look at the bank stocks still trading at 10 times earnings, and with actually pretty good growth these days, growing dividends, higher dividends than utilities.
Right. So yeah, just about
the growth aspects associated with the banks and a lot of the other sectors. There's a lot of sectors where it's not just about dividend yield, but you want to get some dividend growth as well. And, I think that's the lesson to be learned from looking at the utilities versus banks today.
Interesting. So it's not so much the GARP, the growth at a reasonable price. This is more along the lines of dividend growth is what you look for.
Yeah, we certainly like income because, historically a big percentage of annual returns come from income.
Right.
But income for the sake of income is not the most successful investing method, and you don't have to look too far to look at all the things people invested in the last 10 years, whether they're MLPs or REITs or Philip Morris and things like that suck people in because they have high dividend yields.
Right.
Those things are all okay in a reasonable amount, but we see way too many investors putting 50%, 75, 80% of their money into those sorts of investments just because they can say, well, I'm getting a 7% yield.
Right.
Well, you got a 7% yield, but on a total return basis, you lost money in the last 5 years.
Yeah, no, understood. And that's why I was questioning earlier with the negative yields, if that's artificially forcing people to take risks that they don't want to take and just putting them into any sloppy investment without understanding the total return and the other aspects of the investment. They're just being forced into it.
I agree. Yep, I think that was a good question, and I agree with where you're going with that.
Gotcha. So as far as, Dan, how do you manage risk and handle risk, and what mistakes do you see people make with respect to risk management for a security level and also a portfolio level?
Yep. So we do think that handling risk is one of our biggest responsibilities, and over the history of our firm, we've done a very good job of that. But so we look at all the traditional risk measures on a daily basis. What's the standard deviation? What's the correlation? What's the beta? So on and so forth. But it's nice. It's nice to have those numbers. But unless you actually go back and look to see how you performed in May of this year when the market fell 6.1%, or September 24th of 2018 through Christmas Eve when the market fell 19.9, it's kind of useless. So we actually go back and look and say, okay, how did the portfolio perform during those periods of volatility? And is that what we expected? Is that better than we expected? Is that worse than we expected? If it's worse than we expected, and I would say 90% of the time it's better than we expect, but when it's not, hey, we need to make changes. And the biggest mistake investors make is not knowing what they own and not knowing the risks of what they own. And I think the easiest place to look is the large cap ETFs, whether they're technology related or even the S&P 500, which are market cap weighted. And you got into that period of time where they were so overweight technology that I don't think people understood how much risk they were actually taking.
Yeah, that's a really good point. So just to explain to the audience and break it down a little bit, what you're saying here is that if you don't understand the investment, in other words, if you have a basket of ETFs or a basket of mutual funds, what the actual holdings are, what the weightings are in each sector, if you're overweight in one sector, you might think you're quote unquote diversified, but in reality, you're not. In fact, you're very heavily correlated with the market. So if the market takes a dump and it falls, you're buried and you have no recourse. And you think you're protected.
Right. Anybody can go out there and build a portfolio of ETFs that gets 100% of the upside with 100% of the downside.
Right.
What we're trying to do is create portfolios that capture 80% of the upside with 50 to 60% of the downside.
So, and the way you do that is by looking at the undervalued stocks and separating the company from the actual stock, if I understand you correctly.
Yeah, and there's no doubt owning quality, companies that have great balance sheets, good management, and near monopoly type businesses are the ones that are going to be able to do that through good times and bad. So the companies that clearly have shown they're able to grow that dividend in both good economies and bad economies, that allow me to sleep at night and allow our clients to sleep at night.
Understood. You said good balance sheet. Do you have one or two metrics or three or four, whatever it is, as far as how you define what a quote unquote good balance sheet is?
We have a lot of different methods for looking at the balance sheet, and I'm on my Bloomberg all day long looking at the credit fundamentals, and it is interesting. I'm looking at the credit fundamentals on bonds all day, but looking at the credit of stocks is also very important. Looking at the fundamentals of their balance sheet, and quite honestly, that's another part of the bond market that's scaring me a little bit, because I don't think the ratings are truly an indication of how much risk these companies are taking. There's a lot of companies. Yeah. I don't know, 50 to 60% of the bond market is triple B rated today. I think in theory, a lot of those should be double B, which is considered junk. And the reason they're not double B is because they're considered junk.
Right.
And nobody wants to come out and say that.
Right. That's a really, really good point about rating agencies. So back in 2008 with the whole meltdown, one of the biggest things that went unscathed, if you will, or put under the rug, if you will, is that the rating agencies didn't really change their ratings beforehand. After the mess, too big to fail became way too big to fail, because you had the 5 biggest investment banks are now gone. There's like 3 or 4 of them. And the rating agencies, nothing really changed, to my knowledge, at least, before or after the crisis.
I agree with you. There was a bunch of rules written, but I don't think in the big item that there's still an incentive for the rating agencies to give a more favorable rating hasn't changed.
And how do you reconcile that, where you look at the rating agencies' ratings and you look at your own quote unquote, expectation of what it should be? Do you ignore the ratings and just say, hey, I've done my homework and here's what I think the rating should be? Meaning they should be junk versus not be junk?
We use the ratings as the place to start our base analysis.
Okay.
But then we're using some independent rating agencies, and then we also doing our own homework.
Got it. And then with respect to actual credit and ratings, what is from the bond side or the fixed income side, what is one or two big red flags that you see that most people just miss when they analyze fixed income?
Duration. I think
Duration. Okay.
duration is the biggest risk today, and I would say most retail investors don't understand um, the risk associated with longer duration bonds, and there's a reason for that. Since I've been in the bond market. I started in 1988. Rates have basically gone nowhere but down.
Okay.
So bonds have rallied for 30 plus years.
Right.
At some point, that's going to turn around.
Right.
and when it does, and people have these 20, 30, 40-year bonds and all of these preferreds that have, a perpetual maturity, people are going to lose 30, 40, 50% of their market value pretty quickly.
So for the listeners that aren't that familiar with duration or how bond pricing works and how sensitive it is to interest rates, can you just give a little overview about duration and specifically with respect to pricing and what to your point, explaining what the point is, what they don't understand?
Right. So if you bought a 10-year bond today at 170 yield at par,
okay,
if that yield were to jump back to 2.4% where we were only a year ago,
mm-hmm.
you would probably lose 15% of your money. And that could happen fairly quickly.
Just like that, yeah. And people don't incorporate that risk when they look at fixed income. Is that what you're saying?
They don't.
Okay, just because bond.
They don't because, yeah. Right, because they don't, they think bonds are safe because they performed well in the past.
Got it. Understood.
And I think that's the other big macro view for me when I see, what you ask, what are retail investors missing, or what are investors missing? They're always making investment decisions based on the rear view mirror instead of looking what's in front of them.
Oh, that's a really good point. So that actually is a good segue for my next question too, is what are some investing mistakes that you see people make across the spectrum from fixed income to equities or anything else in between?
Yeah, I think people tend to add to their positions that have done well and run up. If something goes from $10 a share to $100 a share, they want to buy more of it.
Right.
Something goes from $100 a share to $60 a share, they want to sell. They can't sell it fast enough. Instead of looking at the fundamentals and saying, "Well, is it still a good company? Is the valuation, is it a fire sale valuation at this point? Is it, do they still have a monopoly? And, is it a short-term concern or is it a longer-term concern?" But I think people are just too quick to sell the losers and add to the winners. And that just, when you do that over time, your portfolio becomes much, much riskier, obviously.
So basically you're saying people, they're very easy or quick to average up, but they don't want to average down.
Correct.
Understood. And your point would be, hey, if you have a good company that's undervalued and you buy it and it goes down in price, that's even more of a reason to buy more of it. You should be averaging down instead of selling it with a stop loss. Is that correct?
That's correct. As long as the fundamentals are still good, absolutely.
Got it. And then how do you manage risk? I know fundamental investors or value investors are more keen on looking at the company and analyzing the value of a company opposed to the stock price. So if the stock price dives like that, how do you manage the risk in the portfolio where you don't have a massive drawdown in any specific
Well, first we have very diversified portfolios, and we rarely have one investment that would be more than 4 or 5% of the portfolio. Okay. So one stock that goes down is usually offset by a few stocks that are going up for sure. So it's not something I would be concerned about. Any one company is not going to have severe, create severe underperformance in our portfolios.
Gotcha. So just being diversified in the portfolio itself, and that'll help offset that risk in the rare event that does happen.
Absolutely.
Understood. And then any other common investment mistakes that you see people make, professionals or individuals?
we get a lot of calls and people talking about at tax time,
Okay.
where they want to take losses just for the sake of taxes, and not really looking at the big picture and saying, oh, have the fundamentals changed? You know what I mean?
Yeah.
And I think people get there's just a group of people out there who hate to pay taxes, and sometimes paying taxes is not a bad thing.
Right.
You made a lot of money.
Yeah.
And 4 or 5 times your money. That 3% position is now 6 or 7% of the portfolio. And I don't care how much I love the company. I need to dial it back a little bit and take some profits and pay some tax.
Got it. So don't make decisions based on taxes. Make them based on the merit of the investment itself. In other words, is it still a good company? Is it still
Correct.
Understood. Yeah, that's a really good point. Or how about that? Not even taxes. What about for any other external factor as well? Whether it be the latest headline, tweet, whatever the case may be, that rattles investors often. Is that something that you see as well, where they make decisions
It
based on?
certainly does.
Noise?
We take a longer term view, and for the most part, we don't get caught up in the day to day. So while the tweets and daily news can be distracting,
yeah,
you really just need to keep your eye on the ball and what is going on with the economy, and where's the economy going to be 2 years from now, 3 years from now, not what's going to happen today, tomorrow, or next week.
So would that be your favorite indicator to make investments? Would be the strength of the economy? Are we a recession or no recession?
Yeah, and our view is that we're not going to have a recession, but we're clearly slowing. We grew at 10% GDP for the last 10 years. Last year we grew at 2.9, and we expect it to come back down to the 2% trend.
So if you do see the economy is going into a recession, would you adjust the portfolio accordingly, or would you just say, okay, this is normal, now let's let it ride and look to buy more stocks cheaper as we get into a bear market or a recession or whatever the case may be?
I would say we look at the investments on an individual basis,
okay,
and say, is the current valuation based on our expectations for the economy appropriate?
Understood. Okay, based on the expectations of the economy, not so much the market, but the economy itself.
Right.
Understood.
And that comes down, the economy means different things to different companies.
Right.
There's companies that do well when the economy is slowing.
Right. So do you have a favorite sector, or do you look at different sectors for valuations, or are you just looking for, hey, what's best based on my thesis on what's going to happen with the economy?
But we want to build a diversified portfolio also by sector. So we have always been investors across the board.
Yep.
But we never get too heavy. No one's going to call us, tech heavy.
Got it.
But we've always been invested in tech, and no one's going to say, well, they're way overweight in utilities. That was never us, but certainly utilities and staples and consumer discretionary financials have always been a part of our portfolios, and always will be, because I think not only do you need diversified across companies, but you need diversification across all the sectors.
Yeah, that's a really good point. So Dan, what about some of the best advice you've received or given over the years, and some timeless advice for investing that you can share with the audience?
I think my stepfather gave me some good advice. He said stocks are the foundation of portfolio growth. He liked to buy the global leaders below market levels due to short-term concerns. So he said, if you're patient and can wait, you will get the opportunities to buy quality companies at good valuations.
Got it.
So always have a little powder dry, and don't feel like you're ever rushed. Just because the market seems like it's going up every day for a month or two, don't feel like you need to make that investment today. There will always be a time when you're going to get a better opportunity.
I love that. That's really, really good advice. And on that note, what about the psychology? I know we didn't talk about that much, but how do you view psychology, and both in yourself and also in the market with respect to market participants? Do you make decisions based on sentiment, or is it more just based on just strictly valuation?
I think we're looking at the bottoms-up valuation based on what we're seeing in the economy. We obviously think that there's reason why you shouldn't wait.
Okay.
And yeah.
Yeah, but just be patient. Patient and wait.
Just
Yeah.
be patient.
Understood.
Psychology of the market. We if anything, we use it as a reverse indicator. When we see high levels of retail investment, that's usually a time to sell, and when everybody's selling, that's usually a time to buy.
Got it. Got it. Oh, that's really, really good. So is there anything, Dan, that I didn't ask that you want to add?
I would just reiterate that our team here is great. I've had my guys in place for a long time. The office support staff is great. We to ensure that our clients have a great experience. It's different. Our team really, we don't have sales guys. We have guys who have investment experience, and we are fee-only fiduciaries looking to be partners with our clients. And as an owner, I'm not one of those guys who's looking to grow my business from 350 million to $1 billion in the next 5 years. If it happens, great, but I'm not out there trying to grow as fast as I can, because if I was, I'd have a different model. I'd have a different business model. We would be using models and ETFs, and everybody would have cookie cutter portfolios, and that's just not us.
Yeah, understood. And you focus on selling all day, every day.
Right. That's not us. Gotcha. We're not salespeople.
Gotcha. And then, Dan, what's the best way for people to get a hold of you or get in touch with you?
Probably our website is the best, www.chathamwealth.com. My email is dan@chathamwealth.com, and if they want to give the office a call, it's 800-472-8086.
Well, thank you very much, Dan. We greatly appreciate it, and we'll talk to you again soon.
I appreciate your time, Adam. Thank you very much. Have a great day.
You too.